On June 12, 2026, SpaceX went public. The stock opened at $135. By the end of day one, it closed at $160. Within days, it touched $225. Elon Musk became the world's first trillionaire. The headlines called it the greatest stock market debut in history. And if you bought in during that first week, you probably felt like a genius. Here is what nobody told you. On day one of trading, 95.7% of SpaceX shares were completely locked up, unavailable, hidden from the market. The entire price you saw, the entire excitement you felt, was built on 4.3% of the company's actual shares changing hands. And right now, a timer is running, a very specific, mathematically precise timer, counting down to the exact moment when 2.02 billion locked-up insider shares are scheduled to hit the open market simultaneously at a time when every structural buyer that drove the stock to $225 has already disappeared. This is not speculation. This is a schedule. It is printed in the SEC filing. The insiders can read it, the hedge funds can read it, most retail investors have never heard of it. Today, we are going to read it together, line by line, number by number, and by the end, you are going to understand exactly why professional traders are already buying September put options on SpaceX and what that means for anyone holding this stock right now. Let's start with a number that changes everything. 4.3%. That is the percentage of SpaceX's total outstanding shares that were actually available for public trading on day one. Out of 13.08 billion total shares, only 555.6 million were in the public float. The remaining 95.7%, over 12.5 billion shares, were locked up, held by pre-IPO venture funds, corporate partners, early employees, and the founder himself. Think about what that means for the price you saw. When SpaceX touched $225 in the days after the IPO, that price was set by a tiny fraction of the company's actual equity changing hands. It was like valuing an entire house based on the price someone paid for one brick from the front porch. The rest of the house was not for sale yet. But here's the part that matters. The rest of the house is going to be for sale on a very specific schedule, and the people who own those locked-up shares have been waiting a long time to sell them. So what drove the price to $225 if most shares were not even tradable? Two things, both temporary, both already gone. First, forced index buying. Under revised fast entry rules, major indexes accelerated SpaceX's inclusion to minimize tracking error for passive funds. The Russell U.S. indexes allowed entry after just 5 trading days. The NASDAQ 100 allowed entry after 15. MSCI fast-tracked inclusion across its global indexes. The result was an estimated $7 billion to $10 billion of forced, price-insensitive institutional buying flowing into a stock with almost no available supply. Second, retail and options frenzy. Brokerage platforms received an unusually large 20 to 30% of the IPO allocation. Leveraged ETFs launched immediately. On day 3 alone, 540,000 options contracts changed hands in the first hour. Options activity matching NVIDIA on a 3-day-old stock. Massive demand, almost zero supply, the price had nowhere to go but up. But forced index buyers only buy once. Retail options frenzy burns out. And when both of those demand drivers exhaust themselves, what fills the vacuum? 2 billion insider shares looking for an exit. And they're not all arriving at once. They're arriving in waves, carefully timed waves designed to look gradual but mathematically converging on a single catastrophic point. SpaceX didn't use a standard 180-day lockup like most IPOs. They engineered something far more complex, a multi-tiered, high-frequency rolling unlock schedule with performance triggers, earnings-linked releases, and automatic time-based tranches, all stacking on top of each other across the first 6 months of trading. To understand the risk, you need to separate the shares into 3 buckets. The first bucket is the public float, the 555.6 million Class A shares sold at the IPO. This is the baseline. The second bucket is Elon Musk's founder block, 6.4 billion shares locked up for a full 366 days. 1 year, no early release provisions. This block doesn't matter until day 366. The third bucket is what matters now, approximately 4.6 billion shares held by early institutional investors, venture funds, and employees. And this block is governed by the staggered unlock schedule, and this is where the danger lives. Here's how it releases. Around day 45 to 60, SpaceX reports its first quarterly earnings as a public company. This triggers the first unlock. Pre-IPO investors can immediately sell up to 20% of their holdings. But because the stock traded above the $175 performance threshold, reaching levels of $185 to $225, an additional 10% performance bonus trigger was met. Total release at the earnings event is 30% of the restricted block. That's 1.38 billion shares hitting the market. Then, the automatic time-based tranches begin dropping in rapid succession. Day 70, another 7% released, 322 million shares. Day 90, another 7% released, 322 more million shares. And then comes day 95. By mid-September 2026, day 95 post-IPO, the cumulative unlocked share volume reaches 2.02 billion shares. That's a 3.6-fold expansion of the original 555.6 million public share float. The total tradable float expands to approximately 2.58 billion shares, 4.6 times the day 1 float. And every structural buyer that drove the price to $225, the index funds, the leveraged ETFs, the retail options traders, they're all gone by now, fully invested, fully normalized. No new forced buyers remain. Fresh supply of 2.02 billion shares, zero structural demand left to absorb it. That's the day 95 cliff.
But this is not just a theory about SpaceX specifically. History has shown us exactly what happens when locked-up insider shares flood a thinly traded market, and the numbers are brutal. 3 cases, 3 warnings. Facebook, 2012. Facebook went public at $38 per share. Similar to SpaceX, it implemented a staggered lockup structure, releasing tranches at 90, 150, 180, and 365 days. Early backers included Goldman Sachs and DST Global, sophisticated institutions with no sentimental attachment to holding at any price. At the first 90-day unlock on August 16, 2012, those early backers sold immediately. The public float expanded by 60% in a single session. The stock plunged 7% on that day alone, hitting an all-time low of $19.88. That was a 47% drop from the IPO price. By September 2012, the stock bottomed at $17.73, a 54% loss for anyone who bought on day 1. 54%. Uber, 2019. Uber's lockup expired on November 6, 2019. 763 million shares, worth $20 billion, became tradable simultaneously. The underwriting banks deployed stabilization mechanisms to slow the bleeding. It did not work. By the time the lockup expired, the stock had already fallen 43% below its IPO price. The supply simply overwhelmed every buyer in the market. Rivian, 2022.
Rivian's 180-day lockup expiration triggered a volume spike and a 21% share price plunge in days. Ford Motor Company, a major strategic corporate backer, immediately sold 15 million shares, not because they lost faith in electric trucks, because they had a massive, concentrated position and the window to exit had finally opened. That is what pre-IPO holders do when lockups lift. They sell. Now, look at SpaceX. On day one, SPCX had only 4.3% of shares in the float. Facebook had 10%. Uber had 10%, Rivian had 11%. SpaceX started with less than half the float of any of these historical comparisons, meaning the supply shock at day 95 will be proportionally far more severe than anything Facebook, Uber, or Rivian experienced. And the options market already knows it. Institutional data confirms a significant accumulation of open interest in September 2026 put options on SPCX. Professional traders and hedge funds are actively buying downside protection right now, positioning for a major technical breakdown around day 95. When the people who understand the mechanics of this market are buying puts, that is not noise, that is a signal. But here is the part that makes day 95 genuinely dangerous rather than just structurally difficult. The financial reality underneath the $2.6 trillion valuation is a company losing nearly $5 billion a year, with insiders who have every rational reason to sell the moment they legally can. At its peak of $225 per share, SpaceX was trading at a price-to-sales ratio of 125. For context, the average large technology company trades at a price-to-sales ratio of 8. SpaceX was trading at more than 15 times even that elevated benchmark, at over 120 times its annual revenue. And what does that revenue actually look like? The company has 3 operating segments. Only one of them makes money. Starlink, the satellite internet division, generated $11.4 billion in revenue and $4.4 billion in operating income in 2025. This is the engine, the one profitable division in the entire conglomerate. The space exploration segment, Falcon rockets, Starship development, generated $4.1 billion in revenue, but posted an operating loss of $657 million. The rockets that made SpaceX famous are currently losing money. And then there's the artificial intelligence segment, the XAI and Grok division, acquired through a debt-funded merger in February 2026. It generated $3.2 billion in revenue and posted an operating loss of $6.3 billion, burning through $5 billion in capital expenditure on compute infrastructure. On a consolidated basis, SpaceX lost $4.9 billion in fiscal year 2025. In just the first quarter of 2026, 3 months, the company posted an operating loss of $1.943 billion. Cash fell from $25 billion at year-end 2025 to under $16 billion by March 2026. Debt climbed to $29 billion, and immediately after the IPO, the company launched a $20 billion bond sale to cover the bridge loan from the XAI acquisition. Now, think about the people holding pre-IPO shares in this company. They own equity in a business losing nearly $5 billion a year, trading at 125 times sales, with a day 95 unlock window opening in September. The stock they received at a fraction of the IPO price is now worth multiples of what they paid, but only if they can sell it before the supply flood depresses the price. What would you do in their position? You would sell, rationally, immediately, the moment the window opened. That is not a prediction. That is the only logical response to a $20 billion paper gain in a loss-making company trading at 125 times sales, with a lockup timer counting down. Let's pull this together. SpaceX went public on June 12th at $135 per share. Within days, the stock hit $225. But that entire price discovery happened with only 4.3% of shares available for trading. The other 95.7% was locked up. Two forces drove the price: forced index buying of $7 to $10 billion and a retail and options frenzy that matched Nvidia's trading density on day three. Both of those forces are now exhausted. Meanwhile, the staggered lockup schedule is running its clock. The first earnings release unlocks 1.38 billion shares. Day 70 and day 90 add another 644 million. By day 95, mid-September 2026, the cumulative supply reaches 2.02 billion shares, a 3.6-fold expansion of the original float, hitting a market with no forced buyers left. Facebook fell 54% from its IPO price at its first lockup expiration. Uber fell 43%. Rivian fell 21%. SpaceX started with a tighter float than any of them. And underneath it all, a company losing $4.9 billion per year, trading at 125 times sales. With insiders holding concentrated positions, they have every rational incentive to liquidate the moment day 95 arrives. The professional options market is already priced for this. September puts are accumulating, the hedge funds have read the SEC filing, they know the schedule. Now you know it too. But here's the question this video didn't answer. What happens to the money? Because the SpaceX insiders, the early employees, the venture funds, the pre-IPO institutional backers, they're not going to sit on $2 billion in cash. They're going to move it immediately into structures specifically designed to protect against the capital gains tax event that comes with liquidating a position like this. Private placement life insurance that shelters the gains completely tax-free, farmland acquired through nested corporate structures the way Bill Gates has done for years, litigation finance generating 15 to 30% uncorrelated returns, art-secured lending converting passion assets into tax-free liquidity. The same tools we covered in the last video, because when the biggest insider selling event in stock market history arrives at day 95, the question is not just what happens to the stock price. The question is where that capital goes next. And that's exactly what the next video maps out.